Hi there, this is the Stockscores Market Minutes for November 29th, 2013. A reminder, if you do not already subscribe to my free weekly newsletter, you can do so at the address you see on screen, that's stockscores.com/newsletters.asp. All right, let's get into this week's topic, which is money follows money. There is a tendency for capital to move in and out of sectors in large quantities. Oftentimes, large investors will simply buy into a sector because it's the hot place to be. And so it makes it effective to buy strong sectors and avoid the weak. A good stock chart in a strong sector has better potential than the same chart in a weak sector. Now we can use the Stockscores.com Sector Watch tool to evaluate where the strength is in the overall market. It's also possible to create a watch list on Stockscores.com of sector ETFs and then monitor those for the Stockscores indicators in those sectors. Once you are logged into Stockscores.com as an advanced or pro member, you can use the Sector Watch tool. Go to Tools, select Sector Watch, and click on either US indices or Canadian indices, and you will see the sentiment stock score for each sector. Now here you can see that precious metals has got a pretty low sentiment stock score, so that would be an area to avoid. Also, in this particular case here, consumer services has a low sentiment stock score. There's a lot of green on the screen, which is evidence that we've got a pretty strong bull market in the US. Now you can do that for the Canadian market as well, but also some of the large cap stocks, the majority of large cap stocks, will also show their sector. So I can punch in MSFT and then go to the bottom of the chart and select sector, and you can also see the chart of the sector index and its corresponding sentiment stock score. Now you also may want to build a watch list, and this is something that free members as well as paying members can do on Stockscores. Go into the watch list creator, and once you know a list of sector ETF symbols, so for example, here's a list of country ETFs, so these are all the ETFs related to different countries, but I've also got a sector ETF sector that I've built, or a watch list that I've built, and it shows me the main sectors that I put in that group, and it's already been created. Once I've created that group, which I've called sector ETFs, I can then go into my slideshow chart viewer or the gallery chart viewer and select that watch list, sector ETFs, and then go through that one at a time. Now I've got small charts here, but if I wanted to switch it to large charts, I click on switch to large charts, and now I can see the charts of the individual sectors in my watch list. And this is a handy tool. I like to do this once a week, go through all of the sectors of the market and see where there's strength and where the market may be lagging. So here, for example, the metals and mining sector is in a downward trend, so generally that would be a sector I'd want to avoid. At the same time, here we have consumer staples in a strong upward trend, a sector I'd want to be long of, although it is starting to get a little bit risky here because you can see this trend is going parabolic. All right, let's get into our analysis of the charts, and one of the simplest things that we do when reading charts is look to see who's in control. The answer is based on whether there are rising bottoms or falling tops on the chart. And the chart of the S&P 500 has rising bottoms, therefore the buyers are in control. This is a weekly chart going back 3 years, and you can see the buyers have been in control for some time. There haven't been falling tops on this chart since 2011. Therefore, we must remain bullish, and although it feels like this uptrend has been long underway, it has not really gone parabolic. We remain in a linear upward trend, and so the talk of this being a bubble really doesn't make a lot of sense because bubbles usually culminate in a parabolic upward trend, and this of course is linear. TSX has been lagging the US market for some time, but it recently broke out and the buyers are back in control here. We've got rising bottoms on this chart, and I don't expect this upward trend to end until we get to that red line of resistance, which we're about halfway toward since the breakout. Treasury bonds are in a downward trend and consolidating downward towards support. So I've drawn in red there the line of support, and if that line is broken, it will be a sign that interest rates are going up because Treasury prices are going down. So if you are concerned about interest rates, watch this chart closely because a breakdown through that support line, which I have drawn in red, is an indication that the bond market is headed lower, and that means interest rates are going higher. China market broke its downward trend line 2 weeks ago. It is doesn't have considerable upside until resistance at 42 on the ETF here, but the bottoms are rising and certainly the chart is looking better. I wouldn't consider this a great chart yet. It is still really in a trading range that has been underway for a couple of years, but at least we have some rising bottoms in the short term. Emerging markets, a similar situation. We have rising bottoms in the short term, but we are underneath long-term resistance at 45 on the ETF. And it's going to take some time for the market to get through that. So I would say that emerging markets have stabilized, but aren't really showing us the excitement that some of the developed markets are, like the US, like Germany. All right, US dollar is in a downward trend line for the past few months. Although longer term, looking back 2 years, we're really in that sideways trend. You can see somewhat of a correlation here between the, or an inverse correlation. When the US dollar goes down, emerging markets tend to go higher. And so the emerging markets have been rising for the last few months. The US dollar has been going down. If the green line of support is broken, that implies a lower US dollar, higher commodity prices, and an improving market globally for those emerging markets. It looks more likely that that will happen because the tops are falling, but until we have a solid breakdown through support, which we did have happen once already in October, although that seems to have failed thus far. But at this point, I would say I am bearish on the US dollar. Gold is still in that downward trend. It is nearing some support, and so the weakness of the past 4 or 5 weeks should probably end in a week or two as we are near support. In fact, it could be bouncing now. We had a little bit of a close above the open for this week, but certainly not a healthy chart, and gold is something I remain cautious of until that downward trend line is broken. We've seen it flirt with it a few times, and each time gold stocks start to look a little better, but we've never broken that downward trend line. Oil prices have fallen quite sharply over the last 3 months as the tensions in the Middle East have dissipated, and we are now at support at the upward trend line. So oil should bounce in the near term. I don't expect it to go back into an upward trend, but it is something interesting to watch here. And basically, I think that although oil is bearish in the short term, I think it's going to stabilize very soon. Fear, pretty much non-existent. We are in a downward trend on fear. The market is complacent. That's a danger because complacent markets often get caught off guard. So bullish on US stocks, bullish on Canadian, bearish on gold, and neutral on oil. It was a relatively slow trading week, so the message of the market was not much different than last week. But stocks still managed to make more gains and remain in an upward trend. Gold remains in a downward trend, and oil has fallen back into its trading range where it should stabilize. That has been the Stockscores Market Minutes for November 29th. Have a great week in the market and trade well.